I want to talk to you about C Corporation distribution rules. And so if you are thinking about C Corporation taxation, you got to really pay attention to distribution rules because they will affect actually everything. So let me give you the overview you need to pay attention to first. C corporations actually may actually distribute money or property to shareholders, and the method used to make a corporate distribution will determine the tax consequences of the withdrawal. And generally what happens here is that non-liquidated distributions, those that do not dissolve the business, will take the form of dividends or a non-taxable return of capital to the shareholders. Of course, a corporation can distribute money in a number of other ways as well, depending upon the sort of configuration that the corporation has, right? It can have a payment of wages, it can have fringe benefits, it can have loans, or it can actually have a payment of rent or payment of other benefits. However, some of these deductible expenses can be reclassified by the IRS as a taxable constructive dividends under certain conditions. Let's talk about how distributions are really taxed. The thing is that the corporation itself does not recognize gain on a distribution of cash to its shareholders. Rather, what happens here is that the shareholders are the ones who must be concerned with taxation. And although distributions of cash or property to the shareholders will reduce the corporation's earnings and profits, such distributions will not reduce the corporation's taxable income. And so the corporation pays tax on the taxable income, and the shareholders pay tax on dividends received. So that's the whole thing about double taxation, okay? Now, when we talk about dividends, now a distribution from a corporation is included in a taxpayer's gross income to the extent that it really constitutes a dividend. And the thing is that you have taxable dividends and non-taxable dividends. And a taxable dividend is actually defined as a distribution from current or accumulated earnings and profits of the distributing corporations computed at the end of the year. And accumulated earnings and profits refers to sums accumulated prior to the taxable year. So in some cases, you have the term retained earnings. And a distribution is treated as coming first from current E&P. So that's the earnings and profits. And if current E&P is sufficient to cover all distributions during the taxable year, such distributions are treated as dividends, and it is actually unnecessary to consider accumulated E&P. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. One thing I want to say here is that when we talk about accumulated E&P, accumulated earnings and profits, you need to understand the relevance of this concept. So accumulated E&P is relevant only if current E&P is insufficient to cover a corporate distribution, okay? Distributions in excess of current earnings and profits are dividends to the extent of accumulated E&P. So the remaining balance is treated as return of capital to the extent of the shareholder's basis in his or her stock, and any excess is treated as taxable gain. Let me just give you an example so we have a clear idea what we're speaking about. So an example here, ABC Corporation has current E&P of 20 grand and accumulated earnings and profits of $55,000. So during the year, ABC actually distributed a total of $100,000 in dividends. So of this amount, $75,000 will be treated as taxable dividends, and the remaining $25 grand will be treated as a taxable return of capital to the extent of a shareholder's stock basis, or as a taxable gain to the shareholders. And let's talk about constructive dividends. So if a corporation with E&P makes a distribution to a shareholder and does not report the payment as a taxable dividend, what happens here is that the IRS will sometimes reclassify this distribution as a constructive dividend, which means that you have a de facto dividend. And this is kind of important because it has tax consequences. Okay, and so when we talk about a de facto dividend, we're talking about a regular dividend. That's what it is, okay? And so the distribution is then taxed as the same way as a regular dividend. So the following are some examples of transactions that may result in constructive dividends. So you have a corporation makes payment to a shareholder's family member without a corresponding level of services provided by the family member. A corporation allows a shareholder the personal use of corporate property such as an airplane, auto, or entertainment facility. A corporation pays personal expenses of an owner, employee, and the expenses cannot be substantiated. And a stockholder purchases property from a corporation at below fair market value. You also have the return of capital. So a distribution in excess of the corporation's earnings and profits is generally viewed as a non-taxable return of capital to the shareholder. In other words, it is seen as merely a recovery or a return of the shareholder's investment in the corporation. So the amount of this distribution first reduces the basis of the shareholder's stock. Then any amount in excess of the shareholder's adjusted basis will be treated as a capital gain from the sale or exchange of property. Boss, I want to quickly remind you of today's topic. We are having a conversation about C Corporation distribution rules. Now let's talk about wages for services, because this is another corporate distribution we need to pay attention to. So wages paid to shareholder for services rendered in an employee capacity are basically deductible by the corporation and taxable to the shareholder. So it's one of those things where the IRS sort of classify things depending upon the operational configuration of the company. So unlike income in the form of dividend distributions, wages are not double taxed. So this creates an incentive for a shareholder in a C corporation to take as high a wage as possible to minimize overall taxes on corporate earnings. So wages paid to the shareholder must be based on services rendered and will be scrutinized by the IRS. In fact, what happens here is that the IRS is paying attention to those elements pretty thoroughly. And the agency generally or routinely reclassifies a portion of the wages as constructive dividends if they do not represent reasonable compensation. Some of the factors a court would consider to determine whether compensation is reasonable include the following. How does the amount of compensation compare with the amount of dividends paid? Would an unrelated outside investor consider the compensation reasonable? How does the compensation compare with the profit performance of the corporation? Those are questions that the court will pay attention to, right? Was the level of compensation arranged in advance, or was it based on corporate profit? Was it the typical level of compensation in the corporation's industry? So those are elements to really pay attention to. You also have fringe benefits. Again, I'm going through the list of C corporation distribution rules here. So fringe benefits. So funds can also be distributed by the corporation in the form of fringe benefits. And so fringe benefits such as health insurance, medical reimbursement plans, you have company cars, education, and group term life insurance are tax-deductible corporate business expenses by the corporation, and excessive fringe benefits distributed to an owner or an employee may also be treated as constructive dividends. Let's have another corporation distribution here. You have loans. So a corporation can lend money to a shareholder. This happens all the time, right? And one thing for sure is that the IRS looks at a few things. The IRS will reclassify the loan as a dividend distribution if the loan is not well documented. So it has to be varied. So it goes back to what I said earlier in terms of record keeping, good record keeping. So the loan must be a bona fide one with a written promissory note signed and dated by both the lender, the corporation, and the borrower, the shareholder. So the promissory note should state the time period for repayment and the interest rate to be charged. And the interest rate must be a reasonable one based on current market conditions. However, if the principal balance of the loan does not exceed $10,000, the below market interest rates rules will apply. In fact, the interest rate can be as low as 0%. This exception does not apply, however, if the principal purpose of the loan is to avoid a federal tax. So the IRS and the courts use the following criteria to determine if corporate loans to shareholder loans are really loans, or let's say should be treated as a taxable dividend distribution. So whether a ceiling existed on the amount advanced, whether or not security was given for the loan, whether the stockholder was in a position to repay the loan, whether there existed a repayment schedule or an attempt to repay, whether there was a set maturity date. Those are kind of important because the courts just want to make sure that there is an element, there is an appearance of contractual obligation here. Whether interest was charged is another consideration. The amount of the loan, the extent to which the shareholder controls the corporation, the earnings and dividends history of the corporation, whether a promissory note was drawn up, whether the corporation made systematic attempts to obtain repayments, and the corporation's ratio of debt to equity. So that's for loans. You also have rent payments. So a corporation can pay rent to a shareholder for use of the shareholder's personal property. The corporation gets a tax deduction for rent paid, and the shareholder reports rental income on his or her personal tax return. However, the IRS will reclassify rent as a dividend when payments are unreasonable. This may happen, for example, when a corporation pays rent to a shareholder in excess of the fair market value of the property. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about the C Corporation distribution rules. Let me give you a few pro tips here. I mean, there are tax consequences of distributions from C corporations, as you probably heard. It's important to understand that the primary difference between C corporations and S corporations is that C corporations are taxed twice, right? Double taxation on earned income. And so the rules governing distributions from C corporations differ from the rules that apply to distributions from S corporation. And it's important to understand that when we talk about C corporations, there are shareholder tax consequences. And so to the extent that a distribution is made from the corporation's earnings and profits, what I just explained to you earlier, the E&P, that distribution is taxed to the shareholder as a dividend. And so the portion of the distribution that is not considered a dividend is applied first to reduce the shareholder's basis in the corporation's stock, and any remaining portion is treated as gain from the sale or exchange of property, capital gain. Now, one thing I want to say here is that when we talk about capital gain, you need to understand that capital gains are a lot better to the shareholder and the taxpayer, because depending upon the long-term or short-term nature of the capital gain, the amount of taxes you're paying is actually reduced, right? Especially, like, for instance, if you're talking about long-term capital gain, basically you have like 0%, 5%, 10%, or 15%. So that's just way better than what your personal income tax rate might be if you were to go with a short-term capital gain. Because if you are paying, like, if you are in the 20 or let's say 30% tax bracket, you are going to pay twice as much on your tax on your capital gains. One thing I need to say also, that when we talk about those things, remember that we're just speaking about the transactions happening at the federal level. You still have to pay. You still have to think about the C corporation distribution rules that affect your state taxes, and especially if your state does have a franchise tax, then you have to see exactly how those things will interrelate, especially if your company operates in several states. One thing I want to talk about here is that when we talk about C corporation distributions, remember that there are cases where a C corporation distribution will qualify as a stock redemption. Okay, now a distribution actually qualifies as a stock redemption only if it significantly reduces the interest of the shareholder in the corporation, and it's one of those things where the IRS actually over the last 20 to 25 years, the IRS has used 4 tests, and only 4, to make the distinction of actually having a distribution qualifying as a stock redemption. First of all, redemption not equivalent to dividends, complete termination of interest, substantially disproportionate distribution, and partial liquidations. Let me break it down for you. So let's first talk about redemptions not equivalent to dividends. So a distribution is treated as a stock redemption if the redemption is not essentially equivalent to a dividend. Although the murky language has been somewhat clarified by rulings and case law, it is not clear enough to rely upon. You also have complete termination of interest. So if the redemption is in complete redemption of all the stock owned by the shareholder, the distribution is treated as a stock redemption. You also have the case where you have a substantial distribution in terms of the proportion. So if the shareholder's voting interest is reduced by more than 20%, and the interest that the shareholder retains after the redemption is not a controlling interest, the distribution is treated as a stock redemption. So that's why we have substantially disproportionate distribution. You also have partial liquidations. So this test views the distribution from the corporation's perspective. It requires that the distribution is not essentially equivalent to a dividend when viewed from the corporation's perspective. We're speaking here about the balance sheet, and that the distribution is pursuant to a plan and occurs within the taxable year in which the plan is adopted or within the succeeding taxable year. So it's one of those things where you have to really understand that, the IRS plays a lot of emphasis on tracking those things. And so Congress has actually added another layer of rules that must be analyzed to determine if a distribution is a redemption. So this attribution rules provide that shares owned by shareholders' parents, children, and grandchildren, but not siblings, are considered to be owned by the shareholder. And similarly, shares held by corporations, trusts, and partnerships are deemed to be owned by their shareholders, beneficiaries, and partners, and vice versa. As a result, shares held by these family members and entities are considered to be owned by the shareholder for purposes of determining whether the distribution qualifies as a redemption. Now, let me dig a little deeper by saying that when we talk about C Corporation distribution rules, and there are some corporate tax consequences, right? It's one of those things where you have to really understand that as a C Corporation, you are actually paying taxes, you are subject to double taxation, and so there are some corporate tax consequences. So a corporation will not recognize any gain or loss on the distribution of cash to its shareholders, but if the corporation distributes appreciated property, the corporation must recognize gain as if the property were sold to the shareholder at fair market value. So it's one of those things where you have to really understand what really works in your situation. Now, there are actually there are two rules that operate as a loss disallowance system. So if the corporation distributes appreciated property, the corporation is taxed on the gain under Code 311, right, B. But that section only covers gain on distributions of appreciated property. So if the corporation distributes property that has depreciated, in other words, the property with the built-in loss, the code that I just told you, that 311B, does not apply. Instead, what happens here is that the distribution is governed by the general non-recognition rule of Code 311A, which actually prevents the corporation from recognizing loss on a transfer of depreciated property. I want to talk to you, and this will be the final conversation here. I want to talk to you about the tax consequences of liquidation. So liquidation is a taxable event for both the shareholder and the corporation. So a corporation may liquidate by paying off creditors and distributing the remaining assets in kind to the shareholders, or selling assets, paying off creditors, and distributing the remaining cash to the shareholders. If the corporation distributes the assets to the shareholders in kind pursuant to a plan of liquidation, it is treated as having sold the assets to the shareholder for fair market value. If the corporation instead sells the asset and distributes, let's say, the remaining cash to the shareholder, it is actually taxed on the sale. Likewise, the shareholder is treated as though the shareholders sold their stock to the corporation for the value of the assets or cash receipts, and the shareholder's basis in property received pursuant to a plan of liquidation is the fair market value of the property at the time of distribution. Thank you so much for your attention. I really appreciate it. In today's conversation, I spoke to you about C Corporation distribution rules. So I gave you the overview and then the pro tips. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.